Afternoon, everyone. My name's James Newman. I run Global Business Development at Webben Group, which is the Alan Howard-backed incubator for Web3 and fintech innovation. Looking out there, I honestly can't think of a more timely topic than the intersection of crypto and macro. Over the last year, we've seen global central banks raise rates many percentage points. We've seen stubborn inflation, while regional bifurcation, fiscal uncertainty, and of course, upcoming elections next year create a vast amount of uncertainty out there. Clearly, timings around a central bank tilt are front and center of conversations both sides of the aisle. And we've seen Ethereum and Bitcoin rally this year before falling back to relatively subdued levels where we see them today. This backdrop creates a number of risks, but also opportunities. And one of the most interesting changes this year has been the crypto's decoupling and correlation from traditional assets. On the flip side, we've seen a number of institutions looking to adopt Web3, in particular around Bitcoin and Ethereum ETFs, further blurring the lines between digital and crypto markets. Now, there's a number of different places where we can kick this off, and I'm joined by a very esteemed group of individuals to my left. I'm expecting this to get quite lively, so I will pass over to Mona to make introductions.
Sure. Hi, everybody. My name is Mona. I am an investor at a venture capital fund called Tokentis Investments. We're a German publicly listed VC on the German Stock Exchange, and we focus primarily on financial services, Web3 infrastructure investments, pre-seed to Series A.
Hello, everyone. My name is Nikita Fadeev. I'm part of Asnara Capital, which is London-based hedge fund. I've been in operation for 12 years, run about $4 billion in assets. I started the crypto effort 5 years ago, and so we have a couple of funds, but our flagship is a market neutral fund that we've been running for the past 5 years.
Cool. Johan speaking as such. So I am a co-founder at Wintermute. I overlap essentially venture and the BD side of the business. I've now officially moved to Singapore. So very happy after spending 12 years in London to come back here for a few weeks. We have grown to be the largest spot crypto market maker in the world. So we do about 16 to 20% of the volumes. We have a derivatives business that we run from Singapore that covers the rest of the world, but essentially that covers about 26 underlyings and covers a lot of OTC counterparties of the likes of family offices up to the $40, $50 billion hedge fund. We have a venture arm that has about 100 investments across the space, so purely on balance sheet. There's no LP capital, but that has about $100 million of deployed capital. And we slowly iterating on new forms of incubation as such. So if you're building in a crypto space as such, don't hesitate to come to us for either investments or liquidity provision as such. Yeah, very happy to be here.
Brilliant. I think it's best to start quite broad. So, Johan, what do you think are the most important themes on the macro crypto side that you're paying attention to?
So, for background as such, so I used to, my previous ventures as such, and my first ever job and my last ever job before becoming an entrepreneur as such, was being a derivatives trader, so trading rates and into central bankers. I also blame Super Mario Draghi and Trichet and so on to actually keep me away from cryptos, because they would tend to give a lot of messaging that would sort of make it sound like it was impossible for Bitcoin to survive, which you knew that wouldn't be the case if you had read the white paper, which sadly happened to me a bit too late, of more like 2017 when we started Wintermute. But the themes have been, I think the space have been quite sheltered from macro until about 2020, I would say. I think it was actually quite isolated from, let's say, the first ICO boom was essentially what I would like to call the Bitcoin wealth effect. So you had Bitcoin going up and a bit of Ethereum going up, and essentially people didn't have any fiat rails and couldn't put the money anywhere, and they just wanted to. We saw through that basically 2017 ICO boom, and I would pinpoint more the first macro, like the genuine impact of macro on the space in 2020 with the state balance sheet money printing from COVID essentially. With the first aspects of the downsides of macro impact and sort of like the financialization or the digitalization of the space, when you start to see the crypto assets essentially correlating with the rest of the financial markets. And it's often easy to describe how that happens. You end up with a hedge fund that just goes and buys some crypto. They also happen to be long equities. They also happen to be long oil. When the equities goes down and oil goes down, they have to take some losses, and they have to finance it, and even if crypto may still be up at the time, they have to sell it, and there's a bit of correlation that happens through that aspect. On the positive side, we've seen a lot of money printing that actually ended up flowing into cryptos at the end of 2020 and especially 2021. I don't know if you really put it as a macro factor, but essentially COVID and having a lot of traders at home helped a lot of fintechs and the overall Web2 to Web3 fintechs, and helped a lot of crypto exchanges and a lot of the space to be a lot more active. Nowadays, the grand scheme of things, as you mentioned in your introductions, well, interest rates as such, I think DeFi summer wouldn't really happen in the current rate environment. So I think there's a bit of like reshuffling about what we do in the space on that front. And yeah, and I think it's just I think on the plus side, crypto is very much seen as a new asset class, and we see that through our OTC business. So we've onboarded now more than 1,000 counterparties as such, and yeah, it's taking shape as such. It's very much seen as a new asset class. So with the downside of starting to be affected by the crypto space, by the macroeconomics.
Yeah, agreed. Thank you very much for that. Nikita, I'd like to bring you in here. Given we touched on the Fed policy, interest rates, how are interest rates and the cost of capital affecting the investing landscape?
Sure. So obviously, the cost of capital is a central component of making trading decisions, especially when you run some high or leverage strategies. And so what's interesting is, so there are, in my mind, two components. One is allocation to the asset class, and obviously the traditional players have historically haven't been maybe too active. Maybe they were coming in through the likes of Genesis, Celsius, BlockFi of the world, and kind of lending them, so they lend into the asset class. But obviously, that being out of the picture, now there are fewer and fewer ways directly to invest in the space, and having some bond-like or fixed income-like returns, and because there are fewer options, and the TradFi options are pretty compelling, especially adjusted for risk. Like crypto doesn't offer the risk premium that you would hope, and so that's kind of one part of the equation. The second is within the space, right? And so I think the rates are only affecting the first part. So the treasuries, wherever they trade, they impact kind of size of the DeFi market, but only up to an extent. I think the kind of correlation causation part is quite light these days, because there are very few people, or fewer than before, where people were chasing yield and deploying to DeFi and to all sorts of market neutral strategies and whatever else. So now with that being less and shrinking, so that's kind of where there is high sensitivity to the rates. But within the crypto, so be it on centralized exchanges and where the rates are there for the margin trading, or be it on some of the DeFi lending pools, or wherever other areas of the market where you would expect some correlation. I'm not sure there is very much structure, just because the people that are, again, sensitive to it are not really participating on the crossover. That said, obviously the availability to lever up, availability to borrow, which is another way that this happens, is a bit higher. But to be honest, it's not that rates increased 5% and the cost of borrowing for those kind of strategies increased 5%. They kind of stayed similar, maybe a little bit higher, but it's highly depends on your risk profile as a company. So it could actually be better now than it was before rates started to increase. Just depend again who you are and how you do it.
No, thank you for that. And Mona, taking this a step further and kind of looking forward, do you have any thoughts around a Fed pivot and what that might mean for dollar liquidity and what that might mean for general asset prices on the crypto side?
Yeah, so maybe just trying to frame it such that so it was, yeah. Sorry,
if you want to answer, go for it.
No, well, I think I'll just pass it on. I got confused, sorry.
Well, in general, I think what we right now, I think we've seen the Fed maybe slower the pace, or at least we won't expect as extreme rate hikes at present. There's maybe a pause. I mean, we know inflation is a lagging indicator, so there might be a bit of a pause to understand, what happens. At least there's no further massive rate hikes in the last announcements. But what we, I think, generally see in the market is that obviously when the rates are very high, asset prices are low. So if we get rate cuts in the future, so if there is a pivot, then of course we will see there's more liquidity in the market and there's more demand therefore for assets, so prices of assets will go up due to that. I don't think we will be seeing an actual pivot in the sense of cutting rates for at least 8 months based on historical events. I would say probably the majority of central banks this time next year are probably going to be considering rate cuts, but it's still a while to go because we definitely have several aspects that we have to consider in the market, and also I think the Fed's role is also to make sure that there's not an early bet on rate cuts, because we have other risks like rising oil prices, for example, that are also potentially impacting inflation, which is obviously the job of the Fed to reduce inflation, to get it back down to 2%. And then obviously we could also talk about the quantitative tightening that is happening in the market. That's I guess a second tier measure that's being taken as well to combat inflation. And if that's getting taken to effect, or if that is working, of course that will also be a factor that will essentially reduce a monetary supply in the market, therefore then be able to affect inflation positively, so lower inflation, therefore be another pathway to the cut of interest rates, and therefore, of course, also for us to have asset prices that are a bit more interesting for at least the digital asset space.
No, thank you for that. Nikita, I'll come back to you. It's becoming increasingly clear, as Johan said earlier, that digital asset prices can't be judged in isolation, and you need a macro overlay, especially looking forward. How are you viewing that kind of crypto macro, crypto traditional asset correlation, the breakdown, the shift? What are the themes and what are the things you're focusing on? And what are vol markets saying?
Well, so one of the biggest forces that could even overcome the laws of physics is the liquidity in the market, right? So when it's ample, then some things, and in crypto in particular, you don't need to look too far to find examples of things that are quite surprising in terms of certain valuations, certain metrics that would raise your eyebrows. And so effectively, I think one of the biggest trends is just general people's appetite and availability of options. So when there was sustained period of very low interest rates, people always chase the returns. They go towards less and less liquid, higher and higher growth opportunities, and delaying the profitability, just selling it to the next guy who has the same framework to think about it. But when these habits break and losses, severe losses are incurred, then it's revaluation procedure that takes place. And so now that we live in a pretty different market environment, that's even though crypto was in November 21, that was around the all-time highs, was doing buzzing in activity and everything. But then as the taps got closed, then the market obviously suffered the consequences. But then I think the space has seen a lot of improvement since then, a lot of maturation, and there are like a few trends that are crypto specific that are opening a new flows of capital. So traditionally it's been the venture that was a way for the TradFi guys to deploy to the space, because that's kind of sits somewhere on a balance sheet. It's very similar to the traditional fintech venture. So we just check in 5 years, 10 years, and see how it goes. Obviously, because crypto turnaround on the venture was much shorter, especially during certain periods of time, then people were forced to reevaluate a little bit. But still, venture was by far the biggest way that institutions were investing, and now having many options to hold some of these commodities, like Bitcoin, on a balance sheet directly or with ETF, whenever that happens, that could be pretty impactful. So I think like overall market picture improving little by little. So inflation situation is definitely in a much better place where it was than when it was. Economy in the US at least is still quite resilient. So that could create a pretty compelling story for the asset class. Yeah, it will be pretty interesting to see what happens.
Agreed. I think it's interesting talking about market structure and the impact of interest rates, in particular around the type of investing strategies taking place on both the VC and the liquid side, and the type of also the primitives that are being built by institutions and also crypto natives. I'd like to touch on this with you, Johan, first, the type of things and how the market structure is actually being affected by, for example, the high traditional interest rate environment now compared to the low one previously.
The obvious thing is obviously if capital is more expensive, it's just more expensive to borrow, you want to borrow less, you get less leverage as such. We had a macro and a micro effect of less deleveraging in the crypto space. As most of you know that we had Celsius, we had BlockFi, we had Voyager, we had quite a lot of the lending platforms. So for us to, like, not sharing any secrets on the business as such, but we essentially moved from let's call it a 6x leverage on equity to about 2x. Not to say just trading our equity for a few months at the end of last year. And 2x seems to be like the soft spot where we get whatever 16-20% of the spot market share as such. So it's sorry about this. It's very much, there's been quite a lot of effects or factors against liquidity as such, liquidity provision as such. There's been some positive development on essentially access for institutional money as such. So we've seen more and more third-party validation. The same way I entered the crypto space in 2017 with an ex-Marshall Wace who essentially just revalidated the idea to me. I was building another venture. And essentially I think everyone needs a bit of a comfort, especially when you come from TradFi, to actually go into the crypto space. And as this eternal ETF discussion, I think Van Eck made the first application about 10 years ago now, or was it the Vinkovive as such? But it's been long running, and I think it's probably less impactful in terms of genuine new money coming into this space. But I think it's probably more impactful in terms of branding and in terms of understanding of new money coming in for the crypto space. Is essentially one of two things: it's either institutional money or it's retail money. So if you think it's retail money, it's more like probably you want to be more in the meme coin. Be invested in the meme coin as such. And if it's institutional money, it's basically BTC and ETH. It's basically things that are well understood by an investment committee, and admittedly in the long enough term by an investment committee, even at a pension fund or an insurance fund as such. So it's very much what we're going for. In terms of relationship to interest, it's true that there's actually multiple effects. Actually, some unforeseen effect, where even in terms of talent. You need quite a lot to actually build an ecosystem. But in terms of you need capital, we also need talent, and we've actually seen really good talent going back to TradFi for some reason, because that last year, FX was pretty active, commodities were pretty active, and we see that coming back and forth. So I think it's good and bad, because it means also it's bad, because we lose some good talents here and there. But it's very good because now we have champions on the other side who know the company and the good culture that we have, and then who can champion us at banks, XYZ, and so on, in terms of just familiarizing those institutions with crypto as well. So there's quite a wide range of macro effects as such on the space, but yeah.
Given you touched on the institutionalization of digital assets and the incorporation, arguably, in portfolios, Mona, I'd love to get your thoughts on the kind of portfolio diversification of using crypto, which you've seen this huge kind of decorrelation, and how you're thinking about it from investing on both the VC side and the liquid side?
I would say in general, I mean, like with this whole decoupling, I mean, we obviously see the crypto market still following macroeconomic trends to a certain degree. I mean, interest rates, inflation do, of course, affect this, and obviously if there are interest rate cuts, there's more interest in higher yield-bearing assets, so therefore, naturally there's a look into the crypto market tendency. What I think the very big difference, and that is also what I think is important when you are an investor to analyze, is the differences that are affecting the cryptocurrency market, both in terms of startups, equity, but also liquid tokens versus the traditional financial market. And I think you can group that in 4 buckets. The first one would be market confidence and adoption. The second, regulatory frameworks and advancements in the regulatory space. Then third, technological advancements, and finally also liquidity. And maybe to shed some color on what I mean with that when you evaluate as a VC, but I think also as an individual investor or as an institution, interesting to look at, for example, in the market confidence and adoption, upcoming things are, for example, the recent ETH futures ETF. Valkyrie, I think, was already approved. The others are probably going to follow. If the Bitcoin version of that, the Bitcoin futures ETF, is any indication, it's actually bearish, right? Because that was kind of the top, and then it actually fell pretty much after that. So that's something to look at, to watch out for, to understand, is it similar, is it different in that respect? The spot Bitcoin ETF, the approval on that, right, is an important factor that could be a catalyst to look out for. Then right now we have the FTX Sam Bankman-Fried court case coming up. Again, maybe there's some bombshells that will be revealed during that. That could cause a lot of volatility. Again, something to look out for when you evaluate specifically, liquid trading strategies. And then, of course, things like stablecoin regulation in the US being quite tricky for banks at the moment, but then in countries with a lot of debt, so the stablecoin of the yen, for example, or the euro stablecoin are probably quite well received because in the Eurozone, for example, it helps to subsidize the debt of poorer members, for example, right? So these are all factors, I think, to evaluate, and also to be aware of that. I think when institutions get more involved in crypto assets, there might be actually more correlation, right, between crypto and traditional finance. So those are maybe factors in the first bucket to consider. And then if we look at the other ones, maybe a little bit shorter, but just to give you a few examples from regulatory perspective, and that's something as a VC, if I invest in equity, I think is really important to evaluate, is to understand what are the frameworks in place. And I think a big movement is that actually there's been a accounting regulation that's, I think, set to be in place by 2025. In the US, I think fair value accounting, that's probably going to provide some certainty on how to actually account for crypto on your balance sheet as an institution in the United States. And that's probably a pretty big advancement to be aware of. Then, of course, MiCA framework in Europe, and then countries like Dubai or Hong Kong or maybe even the UK saying we want to be crypto hubs. Again, very important to keep an eye on that and be aware of that, and also understand where companies are registered and how their organizations are set up. I think are really, really important aspects to consider in terms of regulatory aspects. And then, of course, technology. Something like the Denkun upgrade from Ethereum, I think, is a big advancement for layer 2s, for creating scalability and cost efficiency methods and measures. So things as such, create market volatility, possible large upswings, but as well as also if you're looking at VC investments, is your investment does these kind of upgrades, do they actually cause an issue for some of the investments that you've made, right? Maybe they're solving for the same problem that now Ethereum is solving with upgrades as such. So I think those are all factors to consider. And of course, we can't forget if we look at liquidity in a very broad way, the Bitcoin halving in April 2024, again, probably a catalyst, right, for a potential pump in the market. So I think all of those factors are, I think, important to evaluate both as a trader, as somebody who looks at liquid markets, as somebody who wants to invest, but also as a VC investing in companies with tokens, but also with equity, because essentially you need to think forward for the future and not just at the immediate, because this landscape is so fast and changes so rapidly.
No, thank you. And given you touched on it, it would probably be remiss of me not to jump on the fact that you talked about the Bitcoin ETF. Nikita, do you have any views here, and how does the macro backdrop fit into that picture? And also, can policy be driven from the crypto side here? Do you have any timelines or any views on when there might be approval?
Well, maybe I have few ideas, obviously, but I can't be particular concrete on because that's not really what we spend too much time thinking about. But the few kind of starting points is that the deadlines that are upcoming. So there were a lot of positive motion around grayscale case against the SEC. So I think the deadline for the final decision is coming up sometime soon. Obviously, there were preemptive decisions on BlackRock and a few other ones last week. So I think the next one for them is towards January. I think mid-January or something. Probably once one approved, then all of them will be approved. And I think structurally, again, it will be really, really impactful. I think above all, it will be huge validation for the asset class for Bitcoin, and there will be a lot more channels for investors to invest in. Like the tracking error will be much less, because hedging with futures, the current products are not ideal. Obviously, counting out the grayscale, unless you have a view, and then this could be a pretty compelling product. And having the army of distributors, within BlackRock's, Fidelity's, Franklin Templeton, and so on of the world could be quite powerful. And I think it will be quite, it will be a big deal for the asset class again, and the market microstructure will be changed to some extent, and in quite quickly, and then in the medium to long term, with greater proliferation of similar products, it will be progressively more impactful, and we could finally start to see a bit more diversity in the types of market participants. You kind of historically seen the HFT firms, and then kind of retail, not so much around the mid-frequency or short-frequency guys, just because of the general liquidity of the asset class. But I think having an ETF, I think it will be a validation, and it can be a door opener for a lot more strategies, a lot more market participants to get involved.
Well, thank you for that. And you touched on a very pertinent topic, which is liquidity. And I know it's not necessarily a macro topic, but I think it's worth addressing. Johan, Nikita, what are your views on the evolving market structure, and what does this actually mean? I know you mentioned it regarding high-frequency trading, but how is that going to affect markets going forward and the types of businesses that you're both in?
So we've, it's part of, you can blame us partly. And well, there's one factor that we decided pretty early on. I think if you're an entrepreneur as such, or even in trading, you don't control the environment. You just have to adjust to it. That's one constant. In terms of adjustment to the ecosystem, we have moved back from trading about 350 tokens to a bit less than 200 tokens. Some of it is more about just us being conservative on the regulatory side, but some of it is just simply, if we talked about cost of capital earlier, then if everything you trade has a leg that's essentially a stable coin, and your stable coin leg, cost you an extra, whatever, 5 or 6 points as such, then you just have to be a bit more, careful about what you trade. That means more sort of, blue chip trading as such. It's probably also a reflection of less retail trading per se. So I think we were just talking about sort of the next, there's hints about, what the next, when this next spring or summer is coming. I think for me it just comes from, one of two sources. It's either retail or it's either institutions as such, or both ideally at the same time. And then, institutions is very much, blue chips as such and blue chips covering. We've seen some shift OTC as well. So I'd say we trade, as a percentage of the volumes, we trade more and more OTC, which is probably more akin to what we see in traditional finance. It's probably, traditional finance, it used to be more on the floor, and it probably explains why some of it has shifted to the screen. Even if your markets, like some of the markets, like the Euro stocks, have actually grown quite well together, actually, between the screen and the OTC market growing together. But I would say it's more like, it's been more of a shift onto OTC for larger blocks. And larger blocks are not necessarily huge blocks, they would just be like $100,000 per clip. And yeah, we see more and more sort of traditional finance type of liquidity provision around sort of direct to API, so more models that we see in the FX world. But beyond that, we just focus on building, and then there's not much else we can do.
Thank you. Nikita, any further thoughts?
Sure. So liquidity, I think obviously is much less than what it was, at least like on the screen, if you look at the depths of order books and so on. But that's not to say that you can't trade large quantity, you can't be efficient and execute big amounts without much slippage and without much price impact. But then it's kind of becomes progressively harder for the newcomers, and naturally I think that should be a service that's provided to the end clients and through the OTC, for example. So there are all sorts of new ways that you could source liquidity and get really favorable terms and plug and play kind of setups, such that you don't need to connect to 10 exchanges, have fast connection, and negotiate everything and so on. So it becomes much more commoditized and much easier, more easily accessible. But obviously there is dividend like in everything for doing the hard work and actually being able to do it yourself. So it's kind of becomes two distant worlds. So the HFT firms and market makers and high frequency trading funds, they're kind of keep on getting more and more percentage of the market share, and there it's not so much that you throw in one huge order in one exchange, but you kind of manage it really efficiently. And then the other market participants, they leverage these HFT firms, and they get the service for them. So it's kind of evolution a bit of the market. OTC has been part of the market for a long time, but now I feel like it matured, and there are more and more established players that are offering it, and overall services quite good. So yeah, liquidity to summarize, is smaller, but then again, you need to be like if you know what to do, then it's kind of pretty good.
Cool, thank you. Given we've got about 5 minutes left, there's a few quite interesting questions from the audience. I think the first one I'd like to touch on, and Mona, if you take a stab at it first, is what do you think the macro impact from AI will be in this next cycle, and how do you think it impacts crypto?
In general, I feel like that AI is, we do see AI being used, but I think it's not used as much as some of us think, because we might use it, we might use ChatGPT or other similar, providers of services that help us make texts quicker or write emails or create graphics or so. But I think in terms of actually seeing a real clear macro impact, I think we have a while to go, to be honest. Also because if you look at a lot of the companies that are coming out with AI solutions, they're often just built on top of something that exists like ChatGPT, and they're not actually really making a big impact or have a massive amount of user numbers, similar to what you also see in some of the blockchain verticals, of course. But I do think that we have a while to go, even though we see AI spreading like wildfire, to actually see a macro impact. I think will be not this, but next cycle.
Thank you. Johan, any thoughts on thinking about incorporating them into strategies?
We do to a degree, but it doesn't. I mean, you can use AI for essentially, automation, very much some elements of optimization and some for the discovery, essentially. I think it's very much used for some automation at this stage, so it's not necessarily transformative to a business like ours. Our business is pretty simple. It's just simple to describe, but very difficult to execute. For market making is essentially this: what's the price? How wide are you quoting? How big are you quoting? And that's about it. And then you just need to multiply this across 80 venue and trade 4 to 6 million times a day. And then this is where the implementation is a bit more arduous. But essentially, there's just this. So we don't really have many elements of AI in the business. From the venture perspective, we look at a lot of things in terms of how do you bring insights from especially financial data. AI people love to talk about AI and financial data because it's extremely noisy, and actually if you're able to get some form of insight from financial data, you've got a form of holy grail. The only way I know how to make money from financial data is by two ways: the banking model, sort of a long-term, short-term sort of arbitrage of interest rates, or the liquidity provision model, where you just get paid. You push into a position by someone else who wants to get into a certain position, and you get paid, to take that risk. So I'm probably not the best person to answer that question as such. But in terms of the impact we see on like different firms building in the crypto space, I think the only one that really comes to mind is probably WorldCoin as such. That's allegedly is, registering all these people to put them on OpenAI, I think, or so it's one of them. There's a few local teams that are linked with, I think it's not Blue Ocean, it's an Ocean AI. So there's a few projects that have been out there, but AI and blockchain itself doesn't necessarily goes on too well as such, just because of scalability. In terms of the macro impact, we know all the potential changes to our lives, where we should essentially have everyone should use ChatGPT and should have a virtual PA, and then have allegedly about 25 researchers working for yourself every day, essentially as an equivalent. So I think it's more impactful to our individual lives nowadays, but at the macro level, like in our space, we don't really see the impact. But maybe Nikita, maybe on the fund side, maybe you see that more.
So I think for us, we use it just for productivity gains, I would say. But in terms of strategy development, I wouldn't say it's a primary tool for us. We try to incorporate it, but it's more of extension of our tool set that we have, and just a way how to get to a solution for certain type of questions. And for productivity, well, I think macro impact will be when productivity increases. So if we could do the same job with fewer people, then higher productivity, then that starts to have quite large, or depending on the scale of it, but that could start to have impact at the macro level, but that will probably take a bit of time. But then again, with these things, you never know. Things can turn around quite quickly.
No, thank you for that. Given time, I'll ask one last final question, which is, looking towards the end of the year in 2024, do we think crypto prices have based? When might the next bull run start? And any price predictions, if you're willing to give them, or any views on the market?
So we're fully market neutral. We do obviously have a venture arm, and we do hope that prices go up from the venture perspective. But essentially, we don't really know how to make money things that go up and down as such. So taking this lightly, or putting more my former macro fund manager hat, I've repeated it a few times, but I think the easier filter, and it's not financial advice, but the easiest filter I like to use is if you think that the next retail wave is coming, then you should be into brands as meme coins, as the Doge and the likes. If you think that the money will come into the space, or the new money will come into the space from an institutional point of view, you just need to think of just like an investment community member, and you just think that, essentially BTC is moderately well understood, Ethereum not always, and then maybe some of the, let's call it the emerging economies of the L1s, say the Avalanche, Solana, and so on of the world, that have big enough of a brand, big enough liquidity to make it worthwhile for fund to think of deploying there. But then in terms of pricing, just no idea really.
Again, not financial advice. Probably macroeconomic situation by the end of it should be quite a bit more favorable. There could be quite a few crypto catalysts, so probably more likely higher than lower.
I mean, I would say in general for this year, I don't really expect, the ceiling that we kind of expect for Ethereum to break. But if we look at maybe this time next year, when potentially interest rates are starting to be cut, again potentially, then I think there is a likelihood that there will be a upward price action with Bitcoin halving, coming, etc. as well. However, I don't think that we'll have the bull run next year. In my personal opinion, I think we have a little bit more to wait. Therefore, without necessarily, again, giving any financial advice, but I don't think we have, the end as near as we might all hope. But I think in 2025, there are several macroeconomic catalysts, as well as the points that I've, alluded to earlier when I was speaking, that could drive prices upwards.
Brilliant, thank you, and thank you everyone for joining us.
Thank you.
Thank you.
Okay.